Very good morning, sir. My topic for today is depreciation. Depreciation under section 32. Depreciation applies to fixed assets on our balance sheet. This group of assets is also called as property, plant, and equipment. In short, we call it as PPE. These are items that that are used in the business to generate income for more than 12 months. Examples for fixed assets are plant and machinery, buildings, furniture and fittings, computers, motor vehicles, trucks, and so on. So it is used in the business to produce income over extended period. Now, the word fixed asset doesn't mean that they are physically moving. It means that they are the part of long term business assets. That's why That's why the following non-current. That's why they fall into non-current assets, a part of our balance sheet. Whether the item is fixed asset or not depends upon it. Depends upon it is. It depends upon how it is used in the business. For example, a car dealership buys and sells cars to generate income. These cars are bought by the business for selling them as quickly as possible at a profit. So they are the part of stocks, business, or inventory. Now, at the same time, there are car dealership. The dealership will also have its own cars for the use of business. The cars will be the part of business fixed assets. It is the business purpose of the item that it determines the part of fixed assets or inventory. Now, what is depreciation? The cost of the assets spreads over their useful life. All fixed assets infinite will have finite useful life. Land is the only exception. The length of the useful life depends upon the asset. For a computer, it might be 3 years. For a building, it might be 20 years, and etc. So the reason for spreading the fixed asset, the reason for spreading the fixed asset cost is to match the expense to income. Now, there are various methods of calculating. You can see there are straight line method, a reducing balance method, annuity method. These are the various types of methods for calculating depreciation. And the next point is accounting and tax rules. Tax and accounting rules are set up for the useful life of the asset and the appropriate basis for computing depreciation. Now, let's move on to the next topic, the main heading, depreciation as per taxation. So depreciation will come under the section 32, and what it defines is as per section 32 of the Income Tax Act of 1961. Depreciation is allowed on tangible assets and intangible assets owned wholly or partly by the assessee and used for the purpose of business or profession. This is the clear-cut definition of depreciation. So, in detail, the we'll clear all the points in detail in the further slides. Now, let's go into the meaning of depreciation. Depreciation refers to the provision made for replacement of existing fixed assets. Now, depreciation means any provision which is kept aside, which is made for a replacement of existing fixed assets. Obviously, all the assets are subjected to depreciation. All the tangible assets are subjected to depreciation. Yes, such assets will lose or degrade its value year by year. Once the assets become scraps, or when the asset is no more in use, or when the asset loses its economic value, then the value of the asset should be replaced, or the entire asset should be replaced. At the time of replacement, we require the same amount of market value for the purchase of assets. At the beginning of the year, we purchase the asset, and each year at the end we have to charge depreciation. So for charging that depreciation, we have to consider from the accounting point of view as well as from the tax point of view. Now, now there are certain conditions to be satisfied. Now, before going to this condition, there it is not necessary that the asset will always be eligible for depreciation. In order to claim such depreciation also, there are certain conditions that has to be satisfied. So let's see the conditions. The first and the foremost thing while calculating depreciation, uh, while calculating depreciation, it is allowed in two categories. I've not mentioned yet, but I'm explaining. In two categories of assets. One is tangible and the other is intangible assets. Even as far as tangible assets are concerned, it is not that all tangible assets are subjected to depreciate. Like, what are tangible assets? Tangible assets are nothing but what we can see, what we can feel, which you can touch, are called tangible assets. But intangible assets are nothing but goodwill. Goodwill is nothing but the reputation of the company. If you see the example for tangible asset, we can sit in a furniture, but we can't sit on goodwill. That's not possible. But goodwill helps in generating income. So the assets are classified into tangible and intangible assets. For tangible assets includes building, but it excludes land. For example, if I purchase a land and I construct a building of 10 floors, I won't depreciate for the land, but either we depreciate for the building. And other than the building, we have plant and machinery, furniture, etc. are tangible assets. And intangible assets are technical know-how, trademark, copyrights, franchise, other business or commercial rights of similar nature. Now, let's go to the conditions to claim depreciation. Whether the assets fall in either of the two categories, that is tangible or intangible assets. Then next, whether the assessee or the asset satisfies each of these conditions. Please note down that each of these conditions are cumulative. If any one condition is not satisfied, depreciation will not be claimed. So it is nothing but a cumulative condition. Now, let's go on to the first point. Here we can see assessee should be the owner of the asset. So this nothing but asset on which I'm proposing to claim depreciation has to be under my ownership. It, it can be wholly or partly. So let's say if there is a building and it has two blocks. Now, if uh, either I own a part of the building or the entire building, the ownership remains the same. So the thing here is it's the legal right. You're the owner. So the reason why I'm telling this, in future someone should not come and snatch it from you. So if you're not the owner, for example, you're not the owner, you're the lessee of the building, you can't claim depreciation. Or if you have hired a plant and machinery on rent, you cannot claim depreciation for the machinery also. So the asset should be wholly owned by the asset. Next one, the asset must be used for the business. The main purpose, the second main condition to be satisfied is nothing but the asset should be used for the purpose of business or profession. If you are getting an asset for a personal use, then the asset is not entitled for claiming depreciation. Now, what constitutes for the business or profession is a subjective content. Now, if you give it to an employee, then it is treated as it is used for business or profession. Say, for example, there is an employee, or there is an employee and a company, and our company gives them a residential premises. Very common. Mostly, you can see it in a government companies, wherein they give you houses to live. So this residential premises would set to be used for the purpose of business or profession because they are given to the employee. Similarly, if you put on this, similarly, if you put on some amenities on your premises, then even that is also treated as used for business or profession. Next, the next condition is the asset must be used in the previous year. And I'll explain you. I'll explain this point in the next condition. Then next, depreciation is allowed not on individual asset items but on block of assets under following categories like building, plant and machinery, furniture, and intangibles. You all know. So, what is this block of assets? Block of assets are nothing but it refers to the group of assets under each type of asset having the same rate of depreciation for identifying the block of assets to which an asset belongs. For in simple, for charging any depreciation, what we will do, we used to categorize all the assets and bring the assets to a block of assets. So in general, block of assets refers to the assets which carries the same rate of depreciation, same rate of depreciation, which are chargeable. Such assets are bought together and put together in one category called as block of assets. Now, the condition is the depreciation should be allowed on written down value of block of assets, that is on the last day of the previous year. So if the previous year is, for example, if the previous year is 2011 and 12, so we will compute the written down value on 31/3/12. And in order to arrive at the price cost, in order to arrive at the price, cost has to be taken at actual cost. Okay, you're getting it. Cost has to be taken at actual cost. So depreciation has to be allowed on written down value one, second on the block of asset two, third the last day of the previous year three, and based on actual cost four. And each is known subsequently. Now let's move on to the now. There are certain points that we have to take it into consideration in this. Income tax, as per the Income Tax Act, for calculating depreciation, the Income Tax Act recognizes only written down value method only. We have various methods, but as per income tax, it recognizes only written down value method. And for power generation or distribution companies, it uses straight line method. This is just a key point to remember. Now, let's go for the format for computation of normal depreciation as per written down value. Now, calculation of written down value of block of assets. The first thing is written down value of the block on the first day of the relevant previous year. So, what does this mean? So, the previous year, the previous value, the previous year balance, or the first date of the relevant previous year is a relevant previous year is nothing but the aggregate written down value of all the assets under the block. So the last year's the last previous year's closing balance of written down value is the opening balance of the current year. So for the purpose of income tax, written down value is recognized as I told you in the last slide. Next, the actual cost of the asset acquired during the relevant previous year. So actual cost of the asset required during the relevant previous year. So we have to add with the written down value of the asset. Next, less money received for asset sold, discarded, demolished, or destroyed during the relevant previous year. Any amount which is received either on the following cases, like whether the asset is sold, whether the assets are sold, discarded, demolished, or destroyed, this should be added. The amount should be received only during the relevant previous year, not on the current year. So, previous year plays a very vital role for calculating depreciation. For example, if you purchase an asset during the current year and say, and say and you sell the asset on the same current year, you can't charge depreciation on the current year. You have to charge depreciation for the asset which was bought in this year only during the next year. So if when we are in the next year, we'll be calculating depreciation for the previous year, and this will be our previous year. And next, the amount which the balance which we get after adding the actual cost and after deducting the money received is termed as depreciation balance. Now, with this depreciation balance, we get we have to deduct the normal depreciation as well as the additional depreciation, whichever if it is applicable. So after deducting this amount, the balance which we get is the written down value of the block on the last day of the relevant previous year. Okay, this is the format. Now let's go on to the next slide. Now, before going to an illustration, there are certain points which we have to remember. The first point is after detecting the sale consideration from the written down value, if the balance is negative, it is treated as short-term capital gain. As we saw on the last slide in the format, when the written down value after deducting the sale consideration, when the assets are sold or discarded, if the balance is negative, it is treated as short-term capital gain. And the same, if the balance is positive, it should be treated as short-term capital loss. I'm sorry, the term spelling is wrong. I'll just change it. It should be treated as short-term capital loss. And the third point is no depreciation is calculated on asset sold during the year. As I told you before itself, if you're purchasing the asset on the same year, and if you want and you're selling it on the same year, you can't charge depreciation during the same year. Now, next, normal depreciation is calculated when there is a depreciable balance. As we saw on the last slide, sorry, as we saw on the last slide, after, for example, if the written down value, and if you add some actual cost there, and you list the money received for the asset sold, and if the depreciable balance is nil in this part, then you can't calculate this both a normal depreciation and additional depreciation. This is what the point explains, and this is one of the main and important points to be remembered. If the asset under the block acquired during the relevant previous year is put up use for a period of less than 180 days during that year, on such asset, the normal depreciation must be calculated at one half of the rate depreciation applicable. For example, if you're purchasing an asset on December and the financial year ends at December 2019, the financial year ends by March 2020. So we will be calculating and the period of use of the asset is only for 3 months, and that is which is less than 180 days. So for calculating the depreciation, it will be calculated only of one half of the depreciation. For example, if the depreciation rate is 20%, we'll be calculating it for 10%, half of the depreciation rate. Getting it? Okay. Now, let's move on to an illustration for a better idea. Yeah. From the following data, calculate the depreciation admissible for the assessment year 2019 and 20. The first point is building. Building, they have given the written down value as 5 lakhs. Okay. Next, machinery. Machinery written down value is 8 lakhs, and additions. Additions are nothing but purchases. So if they are purchasing under secondary assets on 36 2018 for 1 lakh, and 31/12/2018 for 1 lakh. Deletions are nothing but sales. They might be discarded, or they might have sold the asset. So the on 1/12/2018 they have sold the asset for 6 lakhs. Next, computer additions on 1/1/2019 is for 60,000, and furniture and fixtures at the written down value is 1 lakh, and motor car for written down value is 60,000. Now, uh, if you see it in a major point of view, the broader point of view, um, we classify the block of assets into major categories like building, plant and machinery, furniture, and intangible assets. But if you can see here, there are no intangible assets. So we will take will block will categorize some assets into their depreciation rates, and then we'll calculate for each asset. Now, so as you all know, there are the rate of depreciation in this. We have already mentioned that is already mentioned in our notebooks. So first one, we'll see for the buildings. Okay, the buildings. For the buildings, the rate of depreciation is 10%. Okay. Now, as per the format, the first thing we have to do is written down value of the building. That is what the first format tells you. Written down value of the asset during the previous year. So the written down value of the building is 5 lakhs. You can see here the written down value of building is 5 lakhs. Okay. Now, the next is any purchases made during the year. That is the additions. There are no additions made during the year, so that will be nil. And then sales during the year for the building is also nil. So the sales is nothing but the discard of asset. So there is nothing, no such information given. So the depreciable balance during of the written down value of building is 5 lakhs. Now with this 5 lakhs, we have to calculate depreciation. As I told you, when there is a balance, the depreciable balance after adding and subtracting the amount which we get with that amount only we have to calculate normal depreciation. So normal depreciation for buildings is 10%. So 5 lakhs into 10% is nothing but 50,000. Okay, so the normal depreciation at the rate of 10%. So the written down value of the block on 31st March 2019 during the end of the previous last closing date of the previous year is 4 lakh 50,000. Okay, buildings are done. Now let's go on to the furniture. But if you see in the question, there is plant and machinery. Plant and machinery, because plant and machinery, even you can consider motor car into plant and machinery. Computers also computer also into plant and machinery. But for if you can see in computers, they have given only additions, but they have not given the written down value. So we'll see motor plant and machinery in some while. So we'll calculate which are the individual assets before that. So uh, buildings are done. Next, furniture. For furniture, the written down value is 1 lakh. And the same as for the building, we don't have any additions during the year, so that will be nil. And less sale during the year, that is also a nil. So the balance which we get is depreciable balance. And for furniture, the depreciation is at 10%. So both buildings and furniture fall into the same category of block. But for a better understanding, I've made it into a separate format or a separate column. So normal depreciation is at 10%. So 1 lakh into 10% is 10,000. So the written down value of the block as on 31st March 2019 is 90,000. So this will come in furniture. Next. Now let's go on to plant and machinery. If you can see, both machinery as well as motor cars falls into the same block. Here you can see in the question, the machinery's written down value is 8 lakhs and motor cars written down value is 60,000. Here you can see. So the written down value of plant and machinery, because we are combining motor car into we are taking that into a same block. So written down value of plant and machinery is nothing but 8 lakhs plus 60,000. That is 8 lakh 60,000. Next, um, next we have additions. They have purchased machineries on 36 2018 for 1 lakh and 31 12 2018 for 2 lakhs. Sorry, 1 lakh. So together it will be 2 lakhs. So additions made during the year is 1 lakh plus 1 lakh, that is 2 lakhs. So if you add it, you will get 10 lakh 60,000. And there is also a sale worth 6 lakhs. So sales during the year will be 6 lakhs. The depreciable balance will be 4 lakh 60,000. Okay, after detecting the additions that the purchases and after detecting the sale discard, the balance which we get is 4,60,000. And here we have to note down one important thing. Before in the previous previous slides, I have told you that any asset which is sold on the same year, which is sold on the same year, and which is less than which is less than 180 days, we have to charge depreciation at half of the depreciation. So here you can see the asset was purchased on 31st December 2018. So the financial year ends on 31st March 2019. So if we calculate, in January we have 31 days, in February we have 28 days, and then March we have 31 days. So if we add, it is less than 180 days. So for calculating the normal depreciation, which is less than 180 days, for plant and machinery, the rate of depreciation is 15%. So that into half is 7.5%. And the asset was purchased for 1 lakh of a year. This is 1 lakh, which was purchased on 31st December 2018. So 1 lakh into 7.5% will give you 7,500. So the asset is used for less than 180 days. Now, with the remaining balance, we have to calculate the depreciation at the full rate. So, on the balance amount of depreciation, the balance is 4,60,000 was the depreciable balance. During the normal depreciation, 1 lakh has been deducted because the asset was purchased on this 31st December 2018. So, the balance is 3,60,000. With the 3,60,000, we calculate depreciation into 15%, that comes up to 54,000. So the written down value of the block on 31st March 2019 is 39 lakhs, 3 lakh 98,500. This is the plant and machinery uh, account. Next. Now we have plant and machinery the same, but for the plant and machinery, computers also come under the same block, but computers have a separate rate of depreciation. The rate of depreciation for computers is 40%. Okay, so that is why we have classified them into a separate account. Now, written down value of the plant and machinery that is computed is nil. As I told you in the question itself, they have not given the return down value of for the computer. They have directly purchased the computers on so and so date. So the return down value will be nil for calculating computers. So that will be nil. Then we have to add additions, that is purchases made during the year, that is given in the question. The amount is 60,000, and then less sales during the year. Sales is not given, so that will be nil. So the depreciable balance is 60,000. Now for calculating, now let's go on to calculating normal depreciation. If you can see, the computers was the purchase, they purchased the computer on 1st January 2019. So as the same thing, any asset which is put use less than for 180 days, we have to charge depreciation at half of the rate. So if you calculate the same thing, January, February, March, which comes up to approximately 90 days. So approximately 90 days. So which is less than 180 days. We have to charge depreciation at half of the rate. As I told you, for computers, it is 40%. So now 20%, so half of the rate will be 20%. So depreciable balance is 60,000, and 20% of 60,000 will be 12,000. Now, on the balance of amount in the last plant and machinery sum, we have, we have depreciated for the remaining balance. But if you can see in this problem, there is no such amount there is no such amount. There is no depreciable balance because there is no written down value, and there is only additions. So the normal depreciation, there is only normal depreciation which we have to calculate, and that is calculated for 20% on 60,000. That is 12,000, and the balance on depreciable balance is nil. So the written down value of the block on 31st March 2019 will be 48,000. Clear. Now, admissible. Now, after doing all the formats, after calculating all the accounts, the last thing which we have to do is we have to calculate only the depreciation. So, admissible depreciation as per section 32 is as follows. So, for the first thing, block one, which we did in the which we did in the first thing, buildings rate is 40%. So, for the depreciation amount is 50,000. You can see it. Depreciation amount is 50,000, and for furniture, the depreciation amount is 10,000. And here, the plant and machinery and motor car, the depreciation is 7,500 plus 54,000. It's nothing but 61,500 at the rate of 15%. 50,000, 10,000, 61,500. And the block 4, which is computers at 40%, is 12,000. So block 4 is 12,000. So there are four blocks. These are called the block of assets, and it's a separate rate of depreciation. And the total of all will come up to that 1,33,500. I get it. So this is how we calculate the rate of depreciation under section 32 for normal depreciation. So if you go into in-depth thing, we'll be having additional depreciation, and we'll be calculating with a different rate of depreciation. There is a separate method. So, uh, thank you. This is all about my talk.